So obviously today I want to have a chat with everyone about financial literacy and go through why it's important. There we go. Why it is important, how we can use this for our benefit, whether you are an employee, whether you're a business owner, or you're in that final stages where you're living your best life. So there's three different stages, three different parts that we want to talk about in financial literacy. And we have a follow-up session next week as well, because this topic is a big topic. So let's get underway. So as I said before, the three areas that we're going to focus on tonight will be how to make more money, how to save and invest, and how to protect your long-term wealth. So in simple terms, there's no point making money if you're not protecting it. There's no point making money if you're not happy. And we've got to save money to be able to invest it. So we can't spend every dollar that we have. We've got to be able to save money to invest it. And we'll play the game for the people that have their webcams on. A thumbs up if you agree or a thumbs down if you disagree. But I think in life, there's a certain amount of money that we each need to make to be happy. So does everyone agree with that? Yeah. Or you can comment if you don't have cameras on. I'll read the comments. And I guess there's a question of how much money is too much, or when you get to a certain amount of money, if you're going to be happy or not. Oh, did my camera just turn off for everyone? Yeah, that's cool. Let's change cameras then. Cool, we'll use this camera. So there's a certain amount of money that we've got to make to be happy. And what is that level? So in today's session, I want you to be thinking about that number. We're going to send out some activities in a couple of weeks to help you narrow down and go through that number a little bit more. But I just want you to be thinking about that number, whether it's $50,000, $100,000, $200,000, $1 million. I'm okay with whatever answer that is, but it's how much money is enough. Because once you know that number, you can work backwards on how to achieve that number. And as I said before, it doesn't matter if you're a business owner, employee, or you derive your income from passive investments. We've still got to understand how much it is, how much that number is. So there's three different ways that we can break down earning money. So whether it's earning money through running a business, through employment, or in investments. Now, there's a lot of business owners on the Zoom. I've seen there's about 42, 43 people have joined. I think predominantly, if I look around at the names, majority of you would be business owners, which is great that you've joined. But equally as important here is, I think majority of the business owners here, 99% would have employees. So when we're thinking about the incomes here, we have to be really careful that we're providing the right balance for the profit of the business, the wages for the employees, and being able to drive income from passive investment. So we've got to be careful of that. So when we get up to the employment section, no one turn off there, because that equally is important as watching your incomes. If we go a bit further into the business type, some of you will be aware of, there's all these different types of businesses, whether you're running a cafe, restaurant, construction company, accounting firm, it doesn't really matter, but there's all these different types of businesses. And most people think about types of businesses in what they do, what's the product, what's the service. But when we think about financial literacy, does it really matter? So does it really matter? I'm just looking around at the group and trying not to pick on anyone, but does it really matter what we do, what we derive our income from, whether it's a product or service? The end goal of a business is to provide us with wealth and income to support our family. And if it's not providing us with income to support our family, then there's a bit of a problem there. If it's not providing us with wealth to support our family as well, there's also a problem. So when I think about business, I just lump them all together. So it doesn't matter what industry you're in, put them all together into the one types or different types. So I have the sole trader type of person. So, obviously pretty much all of us, if I look around again at the list here, most of us may have started off as a sole trader or a solopreneur. And at some point in time, we would have been, looking at that 50, we may have been earning $50,000. We may have been earning less. And I think as a beginner and a sole trader, I've always thought about this as that, you have an opportunity to earn, $50,000 or less, or going up to 200,000. And I see that from looking at, I don't know, thousands of tax returns, working with thousands of people. I look at that and go, well, that's generally what I'm seeing from a sole trader. Historically, you look at this and go, tradie, qualified tradie, goes out on their own, gets a car, gets some tools, and gets a car, gets some tools, and goes off on their own. The problem with the sole trader is it's heavily reliant on one person, being yourself. And when you're thinking about this model, there's nothing wrong with doing that, because if you think a little bit broader and you move away from a beginner to an expert, and an expert, if you think about this, could be, a doctor, high paid consultant, something like that. They can earn some really good money. So doesn't mean that you have to go from a sole trader into a small business or into a larger business, because you can still derive a lot of income if you specialize in a certain topic. So when I want you thinking about financial literacy in business and the different types of businesses, I want you to look at it and go, is this a sole trader, or is it a small business, or is it a business? Now, everybody loves my definition, for those that I've talked about before, of what a small business is. So again, happy for you to weigh in on this one in the comment section. But I always think about a small business as, if you take the owner out, does it collapse? Right? For me, that is the fundamental way of explaining a small business. So again, there's a couple of team members in here of my organization. They would tell you, if you took out me, it'd probably work for a couple of weeks until someone didn't get paid and wages stopped getting paid. And then eventually the business would collapse, because we haven't built it into a business or a freedom business, because you take the owners out, it will collapse. And again, it's not a negative on where you're at in your business life, but you've just got to be clear of what stage you're at in that level of business, because you want to be making sure that you're using the knowledge to ensure that you're empowering yourself to make the right financial decisions. And this is the first stage of working out, are you a small business, or are you a business or freedom business? Now, freedom business or business, depends on which definition you want to go through and think about, fundamentally goes back to, if you're not a small business and you're not a sole trader, and your business can run without you, and I won't pick on people in here because I don't want them getting any big heads or anything. That's awesome. But you're probably in that section where you're running the business or a freedom business, and you've got a little bit more liberty. You don't have to turn up every single day to work and it'll all happen without you. You've got your accounts team, you've got your managers, you're working it well. So whether you've got a cafe, restaurant, construction company, mechanic, I'm looking around, who else do we have here? It doesn't matter what industry you're in. Every single person can get to that point, because you can look at the big end of town and say they've all done it. The whole big end of town are all in that business and freedom business, and pretty much every industry, if you want to, you can scale it to get there. But then that goes back to scaling, and we're going to talk about that a little bit further. Oops. So going back to that small business, and most of us will fit into that level of, if you take the business owner out of the small business, does it collapse? So again, most of us will fit in there. And then you've got two different categories, because scaling a small business, or understanding the numbers on what you need to do to be able to scale a small business, comes back down to, are you selling a product or are you selling a service? And really simply put, Sean Crocker, do you want to jump on? What products do you sell? Are you on mute? Oh, can you not?
No, sorry, I thought you were going to unmute me, but unmute myself. Jeez. Yeah, we have a paint business and a retail store, so we have products with great advice.
There you go. So you're selling paint products and also the advice around that, also in Sydney, for anyone who wants to buy paint in Sydney. So don't just plug myself, I plug others.
Thank you.
So they've got a product, and because it's a product, you're able to scale the product out. And previously, you could have multiple stores and multiple locations. You could do franchises. You could do so many different things there if you look at all the different Bunnings that have popped up over the last 20 years. So when you're selling a product, the product is scalable. When you're selling a service, it becomes different. So I'll pick on myself now. So when we're selling a service, we're selling time, and time equals endless hours. So we can't really do this in our accounting firm, but I'm sure that other bigger accounting firms could do it. We could never take on $1 million worth of accounting work if it was one client in 1 year, because the amount of resources it would take to actually do that job would be ridiculous, and it'd be just so much pain and suffering on my side. So you look at that and go, if you're running a service business, generally they have higher profit margins than a product business, and generally speaking, your revenue is a lot harder to achieve than a product business, but the profit would be higher. So it always goes back down to, if you're running a product business and you want to scale it, you could scale a product type of business to achieve financial freedom. Or if you're doing a service-based business, you could scale that. Or then it comes back down to, what do you do with the profits? And that's what we're here to talk about today, is the financial literacy side of things, of whether you should be investing your profits into the business to grow the business, into other assets like properties, shares, term deposits, gold, that type of stuff, into yourself. If you're still that's sole trader aspect, you probably need to learn some more stuff to be able to grow into a small business. As a small business, you probably need to learn more to be able to grow into a business. But we're now at the point where you've got to look at this and go, and every business is different, and that's awesome. But you've got to look at this and go, do you want to take the next step? And depends what the next step is for you. So the next step might be bypassing scaling business, like my business. I say to people all the time, I'm quite happy with the size of our business. Hatch is a great size, and I'm quite happy with that. I'm more interested in making sure that the product and the service that we provide is of a higher level. So instead of me going from $3 million to $4 million next year in revenue, I'm just focused on making sure that our level of service and the advice that we give, the timeliness of it all, improves to a higher standard. So the people that we currently work with are more happy. That's what we focus on. So we're going, well, we're actually not interested in growing and becoming 50 team members, 100 team members in the interim. We're focused on having the best 30 team members and having high focus on that. So that means that the business itself, my business, won't go from being a small business to a financially free business, or won't go into become a big business, because I'm not designing it to be that way. And that goes back to the numbers of why I've made that decision. So over the next couple of weeks, again, we've got some activities that will be going out that will be helping you make that decision and have a think about that, and look at the different strategies, if you're here, of whether you should be investing in your business or you should be investing outside of your business. And over the past 8 years, Jenny and I have heavily invested in the business and outside of the business. And that's how we've mitigated the risk of running a business, but also how we've been able to maximize the wealth that we've been able to create through shares, properties, and other businesses. Going back to employment income now, all you business owners, please do not turn off your minds, right? This is critical in the sense that most of you employ. So fundamentally, you need to be across and understanding this aspect of it. And if you look down the bottom, it says that the average wage in Australia is $1,250 per week plus super. And you think that is a lot or not a lot, depends on your perspective. And when you break down employment income, I look at it and go, you've got unqualified people, you've got people that have got a qualification, whether it's a trade, whether it's a professional, that type of stuff. You've got people that become career driven, absolutely have people that are family driven, and you've got people that become experts in that space and climb the corporate ladder. So you've got 5 different competing thoughts around income, employment income. And each of you that run businesses, I want you to be thinking about this for your team. Which category do they fall into? I have people that would be, their key drivers would be around family, and that's awesome. But that means that I'm going to provide as an employer an environment that makes sure that they're not working 80 hours a week. Because if they're working 80 hours a week, they're going to quit. And that's going to cause me problems because they're driven around the family. So we want to be looking at this for each team member. And if they are, say, unqualified, the question is, do they want to become qualified? Do they want to start going up that ladder? And some people do and some people don't. And for those that are employees here, there's nothing wrong with that, but at least understanding of where you are and where you fit in that ladder and what you're trying to achieve. Because it's a bit unfair to have, if people have unrealistic goals and expectations around their career, if they're wanting to be a CEO of a business, but they're not doing the work to become skilled enough to be that CEO. And you've got to have a career plan, and you've got to work with, you've got to work on certain aspects for that. So that's how I break this down, and I'm thinking about it broadly. And I look at my team, and I gauge everything here between my accounting business and my steel business of where the different people are and how can I help them to achieve their goals. Some of them, again, are on this call, and I asked them, I asked everyone the other day, what are your personal goals and what are your career goals? And we went through an exercise with about 10 people, and I wanted to understand what they were to make sure that we as an organization can live up to those. So financial literacy here is not just me thinking about how much money can I put in my bank account to buy that property, buy that holiday home. I'm also thinking, how much money can I put in my team members' bank account? Because I want them to be able to, buy a house. I want them to be able to not be stressed out about money. Because if they're not stressed out about money, they're less likely to get a divorce, right? Because that's the #1 cause of divorce. And they're more likely to stay with the organization and be quite happy to, continue working for hopefully an amazing organization. And from the employment strategy, we talk about, depends on where you are. So if you've got a focus on family, you might be happy with the average income of $1,250 a week because that's average and you're happy with the average. Again, there's no negativeness about that. So I thought about that average. And I try to make this as less complicated as possible, the least amount of complication as possible. And I thought about, if you weren't the average income when you were, say, 20, and you worked for 40 years and you put that money into super and you earned an average return of 9%, which is the ASX average, we increase that by 3% each year, what would that actually be? And in today's money, because my brain doesn't comprehend how much money will be in 40 years' time, so I did the maths for everyone. In today's money, it's around 1.6 million, which would give you dividends of around, 80 grand a year, plus you'd have capital growth. So the question is, from an employment perspective, is once you understand what your team members' objectives are, and your team members understand what their objectives are, they can be financially free quite easy with enough time. Compounding is amazing. And that's something that we're going to talk about in a lot of detail next month on our wealth creation webinars that we'll be doing. And we've got some different guest speakers on that will be enlightening for some people out there. But you don't need to do much to be financially free as long as you're consistent, you compound, and you start early enough. If you start this strategy, in your 50 and you have no super, you have no wealth creation at all, then it's a different conversation of how much money you need to put away. But if you think about just your superannuation that you'd be getting off earning $1,250, in 40 years' time, that could be $1.6 million with an easy strategy. So it doesn't mean you have to shoot the lights out. Really quickly, I wonder if my mum's in here. If I say a negative thing about my parents, will I get in trouble? Probably will. But the question that I have, and I'll do it anyway, the question I have is, it's, if you think about it long enough and go, the compounding effect of wealth creation is that if you start young enough, you can be well and truly set up when you're, 60, 65. That's why it's so important that whether you have, if you're older than 20 now, everyone here, as far as I know, is older than 20. That's why it's so important to already be down this journey. Whether you're an employer or business owner, you should be down this journey. And if you've got children that are, 20 or under, the question for them is that they don't need to go out and shoot the lights off, go become a doctor, kill themselves working 80 hours a week to become financially free. They can do it with the average income. So it means that they can go chase their dreams and stuff that they enjoy doing that fulfills them. But you have to be willing to, one, share that with them, teach them about the wealth creation, and show them that it's not all too complicated. Because in life, that's what we're doing in our society. We're not teaching or imparting that wisdom along the way. And just in case my mum is here, she has taught me a lot about financial literacy and wealth creation. I definitely saw my sister, so she'll probably give me a crack later for not calling her out earlier. And the final one that I want to talk about is passive income. So whether you have a business that's under management, we have, shares listed on the stock market, or we have investment properties, etc. The other form of making money is through the passive side. So at today's count, I think it is 10 or 11 properties that we have. So we drive a lot of passive income from that. I haven't checked the stock market because I try not to check it on a regular basis because I used to be a little bit addicted. So anyone put up your hands if you've been looking at the stock market every day and is a little bit addicted like I was. Yep, a few people's hands going up. Definitely addictive to do that. I think we've got, $900 or $1 million in shares. And the other one, we've got a business under management, which is a steel business that we only created, say, 6 months ago, but we created with the purpose of it being under management. That it's not my time that goes into it more than 1 or 2 hours a week. It's other people's times. So because of that factor, I consider that as being passive income. And on that, we talk about the passive income, and this is where we go back to if you're running a small business and you want to evolve it into a financially free asset or a business under management, you've got two options. You can either just exit it at that point and sell it for a really good multiple and then put that money into other investments because it's maybe less stress, or you can keep it. Now, with the steel business that I have, it's doing 6 figures, so over $100,000 per month in less than a year, and it's all under management. And the question is, one, how did I come up with my money to do that? And two, how did I come up with the decision to do that? So in the activities that I send out to you, there's going to be a way for you to work through that yourselves, but because each person's individual circumstances is going to be different, so the activities will help you work through that. But when I look at this, I go, one, I had the accounting firm that was a strong business that was allowed me to bank money over the last, decade to put into investments. And off those investments, I've done quite well. So what I decided was, and, I joke around a fair bit when I'm up on stage about this, but what I decided was, instead of buying a red Ferrari, because I sold a house, made 150% gains on that house, but really return on investment goes from $30,000 deposit into 400 grand cash. So instead of buying a Ferrari, I decided I would put that money into a business that was under management. So when you're looking at, you can even buy those businesses too, everyone. You can obviously buy businesses like that. But I put that money into that business. And instead of me buying it on a car, spending it on a new house, putting it down as a house deposit, I put it in an asset that's making me money. And we'll come back to that one a little bit later. Obviously, the stock market, you can be a day trader, you can buy index funds, managed funds, Australian stocks, you can use a stockbroker, you can have international stocks. The whole world's your oyster when it comes to the stock market. People are mostly gonna, they're gonna do it themselves. I see this all the time. People do it themselves. They go buy some silly company like a weed company or something. They lose 10 grand and then they say the stock market's shit. So it's one of the worst things that you could do is blame a whole industry on your poor decisions when it comes to the stock market. Some poor decisions that I've made, mostly at the start of my investment journey, was I put $7,500 into Oil Search. That's an oil company. Probably doing really well now. I haven't looked it up, but I kid you not, the next day it halved. And that was really frustrating because that was like all my money that I had, and I put it into the one company and the next day it halved. So what did I do? Because I'm a risk taker, I doubled my investment and I went from 7 grand to 14 grand. And I'm like, I have faith that it will go back up, and it did go up. It took a year or two, but it did go back up and I did make some money off it. But is the whole stock market at fault for my naivety in putting 100% of the money that I wanted to invest in it? Or is it my fault? Is it a lack of understanding of how the whole industry works? Or is it the industry's fault? So when we think about the stock market here, we all have bad experiences because we've all done silly things. I definitely have on the stock market. And it's not the stock market's fault, it's my lack of knowledge. And that's where you look at this and go, learning about the stock market before you're investing in it is critical. Or going into index funds where it's, the top 50 companies in Australia. I don't have to think then, I just buy the top 50 companies in Australia. If they go up, I go up. If they go down, I go down. No thinking, easy. A managed fund is like an LIC, listed investment companies, when you're effectively paying someone else to group your money and manage that money, and they'll go buy those stocks. And using a stockbroker will generally, they're going to pick a portfolio that's right for you, that takes into consideration your risk profiles, and they're going to do that. All of that entails different options there. So day trading, again, over the last 10 years, I've probably seen 200 tax returns that people day trade. And in the comment section, if you want to participate, who reckons more people made money or more people lost money? So you comment below. Let's have a look at what people are thinking. So did more people lose money, or did more people make money? A couple more seconds on day trading. Yeah. And so everyone's saying lose money or lost money. And I kid you not, I reckon in 10 years, 12 years, I've probably only seen less than 5 people make any money that's material from day trading. And I have seen minimum 100, 200 people lose money. And I bet you today, they say the stock market shit. Bet you the 100, 200 people that have lost money, and some of them were big money, like hundreds of thousands. I bet you they say the stock market shit, it's all, a scam and blah, 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 blah. But it goes to their lack of understanding of the market and how you should be investing. I'm sure there are that one person who does it on TikTok or Instagram that shares their story of how they make millions and pay me money and I'll show you. There's going to be one of those people. But predominantly, people that day trade lose money. I mean, the joke goes, and I like this joke a lot, how do you make a small fortune? You start with a big one, you day trade, right? You just lose it all. So what I want you to be thinking about here is that if you're successful in your employment, or successful in your business, you have an option. And one of the options to park your money is in the stock market. But you can't willy-nilly do it and, take guesses. Again, using that example, buy weed stocks, I like buy now and pay later, that whole industry, which was more about hype than actually making money or profitable companies. And that whole industry is collapsing now. But the ride was fun. Like, don't get me wrong. I loved the journey of being in Afterpay from $28 up to, I think, maybe 80 or 85 that I exited. I enjoyed the journey, but I knew that I was risking that money every single day that I had that money invested in Afterpay. I knew it was at risk. So it's about making the right educated decisions here and not going in it alone if you're not an expert in that space. And that's where I use, different people for that. But we're going to have some really cool guests on next month that will be talking about this at different levels. And so obviously stay tuned for that one. And in investment property. So we played a game in my office, and it was a game that I was a little bit disappointed at some of the answers. And so my definition of investment property is a property that you purchase for the sole purpose of making a capital gain while it covers all your cash expenses, including the loan repayment. And the number one reason why I believe this is critical in your decision-making as investment properties is right now, the whole market, is really turbulent because interest rates are going up. Some people are freaking out. Some people like me are like, I'm jumping in. I just want to buy more property. I just want to look for those people that are freaking out and buy their properties off them at a 10, 20, 30% discount. And you'll be surprised it is happening, and it's quite interesting. And the number one reason why when I buy property and the properties that I purchase, it's got to cover all of its bills, is I don't want to rely on my business income to cover the bills. I don't want to rely on my employment income to cover those bills. I don't want to be in a situation where I'm forced to sell an asset because I stuffed up in the accounting firm and got sued. I want to be able to keep those assets because I want them to be able to pay for themselves. So that is why when I'm buying investment properties, that I'm buying ones for the sole purpose of making capital gains, but they've still got to cover my cash expenses. So what that means in simple terms is when I buy a holiday home and Airbnb it out, that is not an investment property in my definition, because it's not for the sole purpose of capital gains. It's for, holiday home down in Torquay or Phillip Island for me to, take the family, friends and colleagues to. That's not the sole purpose. So I'm going to have an emotional attachment to that property, and I'm going to look for things that I shouldn't really care about as an investor. I'm going to make the wrong decision because I'm having emotional attachment to it. So when I'm buying property, it's the numbers. The numbers tell me if I should buy it or not. And again, these activities that we'll be doing, that I'll be sending out over the next couple of weeks, you'll be able to look at different properties and look at the numbers and make a decision based on the numbers, not the actual property. So when I buy a property, I don't even care what the property looks like. It's very low on my care factor. I care about potential for capital growth and the rent return, because I'm buying an investment. Like, I don't care if it's in a shitty neighborhood. I don't care if, I care that the building can't fall down because I don't want to, incur a cost or anything, but I don't care if it's got like pink walls or something on the outside of the building and the building's like all pink and that looks strange and, whatever. I'm not going to paint it unless it's going to increase my rent. And my rent's got to go up by a lot more than my expense of doing it. So we'll go over those investment properties in a couple of different examples over the next couple of weeks for you to look at those, and also next month too. So the Hatchaway. So the way that I've just described there is how I buy the investment properties is, I teach this and I, tell all my clients that, that want to buy investment properties about that. So we're going after those cash flow positive ones because I never want to be forced to sell it. There are so many examples that I've seen over the past 5 and 10 years of people being forced to sell an investment property. And then we look up the price today, and I bet you it's like doubled. And I never want to be in that position. I look at some of the properties that my family used to own, and I look at the values today and I'm like, oh my God, why did we sell these? But there was a reason for it. because obviously there was a financial situation. We had to sell them for whatever reason, and we couldn't hold on to them because they weren't driving enough rental income to cover the bills. But fast forward now, some of those properties that we owned 20 years ago are worth, you know, $2-3 million more than what they were back then, which is more money than some of my family members earned in that 20 years. So it's crazy that the decisions that we make can have a massive impact on our financial future, where holding on to a property could equal more capital gains than working. Like, I physically don't have to work to make this money. That's why we do so much in property. That's why we go so hard in properties in mine and Jenny's wealth creation, and why I implore every person to get into that market if it's the right property. And I will put a caveat on that one. My wife, Jenny, every single time I'm like, maybe we should swap an asset, she gives me the lecture on how dumb I am for wanting to sell a property. So sometimes you might want to look at replacing an asset for different reasons. And again, you got to weigh up the numbers to be able to do that. You got to take the emotional side of things away and weigh up those numbers, because it, again, can have a massive impact on your financial future. So we've talked about 3 different, you know, types of investments, or 3 different ways of making money. But so what? If you don't have money to start off with, then how can you do any investments, right? If you're here going, Gary, I've only got $1,000 in my bank account. How can I buy an investment property? How can I buy a house? How can I buy shares or a business? It's not possible. And that's where it comes back down to, you know, you actually have to be in a position where you can save money to invest. And each of you are in different financial positions. So I think about this very broadly and go, well, it's in my interest, me personally, to make sure that I have enough money in my bank account to buy investments. It's not in my wife's interest because she's got her own things. It's not in my parents because they've got their own problems. It's not my children. My children, one child, sorry, she just wants to eat, sleep, and poo. Soon she'll probably want toys, right? I'll probably have to start buying toys and, you know, all that type of stuff, and school fees. It's not in their interest. Everyone else just wants stuff, right? They want you to buy clothes, buy a nice house, buy drink bottles with, you know, your branding on it. You know, they just want you to buy stuff. But it's in my interest to make sure that my family has the money to buy and to build our wealth creation. So it doesn't matter if you're an employee or a business owner, you've still got to take that ownership of that. And it's as simple as just starting with 1% of your income. So whether you run a business or you're an employee, just 1%, and putting 1% away each week. Because it's not about the dollar value at this point, it's about the compounding effect. And everyone's in different positions. So then you might decide that it's better for you to get that 1% that you've been putting away and pay off a credit card, and then cut up the credit card and never have a credit card again. It might be better for you to pay off your car loan because your car loan is now gone up to 12% interest rates. So the activities that I give you in the next couple of weeks will show you the differences of where you should be putting your money based on a return on investment, because that's all it is. Whether you've got a car loan, 10% interest, you've got a house loan that's 5% interest, or you've got a business loan that's 20% interest, you've got to work out where's the best place to put your money. And right now, with rising interest rates, we've got to be really careful about those loans. But even if we just start off with that 1%, that's all we've got to do, 1%, and let it start compounding. Got a late addition. And going back to the employee side of things, and this is what's really fascinating before, that your number one strategy as an employee is for wealth creation and your retirement is superannuation. So before I said, if you just did the right investments by putting, you know, getting 9% return over the, you know, over the long term, which is the ASX average, because it's gone down at the moment because the market's gone down. Your number one investment is super, but that doesn't mean that you just forget about it. That doesn't mean that everyone here who's business owners that have employees that, you know, pay their super bills. If you leave it up to people to realize that they're in a terrible super fund and they're getting terrible returns, you can look here at the differences. last year was a bad year, so it's probably good for this example. And you can see here how they vary. So all these 10 super funds, you can see the various outcomes that they achieved. And then you can look at the past 20 years and what they've averaged over the 20 years. And I'm not saying you should just tell all your employees to go into Host Plus, but what I am telling you is that, as an employer, we have a responsibility to make sure our employees are looked after. And if I have the choice between educating my team to make sure that they understand where they should be putting their money in super, which super funds they should be putting it in, and what to look for, opposed to them complaining that they need an extra $10,000 because they've got no money in super, I'm going to pick the education. And that's what financial literacy is the more you educate yourself and your team, the less it actually financially costs you, because if they're killing it financially, personally, they don't care about getting, a 50 grand pay increase because they don't have money to buy an investment property. They're happy to get the CPI. They're happy to get, the average for their industry. They're happy to get the averages, and they're not freaking out about money because they're coming close to retirement and they've got nothing. Most people that I know or that I work with, they come to us at 30, 40 years old, and they've never even considered what their super looks like. They don't even know how much is in there. They're not actively looking at it. And part of financial literacy is actively managing your money, and super is a big part of that. And a big part, and predominantly for your team members, is probably their number one investment asset that they've got. So at least just having that conversation, making them aware of what they should be looking for. And some of these ones here might be ethically invested super funds. So people might have different ethics on how to invest money, and that's why they get a different return on investment. But you can look here that Host Plus is actually the only one who's at the average industry average for the ASX over the last 20 years, and they're the ones that have achieved it. Everyone else is below. And this gets really bad, and you can look it up now because we have a list of the worst performing super funds each quarter. And some super funds now are not allowed to take new members in because that's how poorly they're performing. So that means, and there's I looked it up. I want to be careful without naming them because I might get myself in trouble. But I looked it up and I counted that there was over 2 million people in underperforming super funds that the ATO, ASIC, APRA have gone, you know what? You're not allowed to take new members because you're running a terrible return on investment. 2 million accounts. And that's a lack of financial literacy on this topic. So as I said, you got team members, you're now responsible for making sure that they at least look into this and they understand it. Doesn't mean that they have to move. They might love to be in one of those ones there, or they may hate it and they just didn't know. But it's up to us to educate the team that we have, because as I said, education might take 1 hour and might save you 10 grand because you don't have to give them a pay increase because they know that their financial well-being is looked after. Most employees, the number one priority I would say for an employee would be to buy a house. So sometimes, working out a strategy where you can help them to, save up a deposit, get them into a house. How much money would I want to spend on my housing costs? And the banks use a 30% ratio. And I think 30% of your income is what you'd want to maximum be spending. Any more than that, you start thinking about the Taj Mahal. You start thinking about, are you overspending on a house? Because you're probably going to be getting taxed at 20, 25, 30% of your income that you're earning. You're probably paying 20% in taxes. So if you're earning $100,000, you've got, say, 30 grand goes to the housing costs. You've got 20, 25 grand goes to tax. And then, then you're left with, in this case, you'd be left with less than 50% on lifestyle. And that's got to include your investments. So one thing that I learned when I was an employee, which was imparted on me, was any bonuses I got, like cash bonuses, I actually invested the money. When I got a pay increase, I took that pay increase, that component of it, and I invested it. I tried to keep my lifestyle spending at the same level as when I was a first year accountant. And that stayed with me all the way up to more recently, I think it was like 12 months ago. So about 9 years, I tried to keep the exact same lifestyle spending. And then I decided to be silly and start splurging a bit more. But I look at that and go, whether you run a business or you're an employee, do you let your lifestyle creep up because you're earning more money? Do you start having more? I'm just trying to look at fancy stuff over on my desk. I've got an iPad. This one here, some of you would have seen me use it before. I've got a iPad. I bought that maybe 4 or 5 years ago. It's like $1,500 back then. Still works perfectly fine today. Haven't upgraded it. I don't even know why you would upgrade that, because it's like perfect for me to write notes on. Also, you can write notes on an iPad. So I kind of have that dilemma between an iPad and an iPad. But do you let your lifestyle creep up? So whether you're running a business or an employee, do you just go, boom, I'm making 200 grand now. I'm going to spend 200 grand on lifestyle. And we see it happen all the time. And that's one of the number one problems that we see in business, is that people allow their lifestyles to creep up because their income increases. And then if there's a drawback in their income because the business has a downturn, economy's gone shit, Christmas happens, whatever, the lifestyle stays the same. And if your lifestyle stays the same, but you've got less income, you start going into debt. And again, this is where those activities, because everyone will be at different stages, this is where those activities are going to help you. So we will send them out so you can think about your own situation, but at least this gives you the knowledge of why it's important to be thinking about this type of stuff. Now, in business, it's really critical of understanding, are you trying to move through the stages? If you're a sole trader with 0 employees, you'll hear me say, let's go out and get a couple of employees. We've got to build a team. We've got to build 1 team. We've got to build 2 teams. We've got to build 3 teams. Some of my most successful traders that I've worked with, we've gone from having a sole trader business to having, I think it's 20, 25, 30 team members. And now their performance, I think they made in the first year of revenue, maybe 70, 75K. And now they'd be looking at, $2.5, $3 million a year. But the point here is you've got to make profit, and you've got to be able to invest that profit in growth. If you're not making profit to start off with, we can't invest it in growing the business if that's what you're looking for. And like I said before, the decisions have to be made between, do you invest in growing the business, or do you invest in growing your wealth outside of the business? And Jenny and I strategy has been to do both. So we look at our P&L, and we take a revenue item and we go, this revenue item is going into shares. So no matter how much revenue we generate from that item, it will be going to the stock market. Even if the overall business loses money for that month, that revenue item isn't the problem. That means that Gary's probably dumb and spent too much money on something, and he wasn't paying enough attention to the numbers. And that's why we lost money in that month. But that had nothing to do with that revenue item. So this is why when you look at my share portfolio, and I don't mind showing people privately, this is why we've got it up to the number we have, because we just took a revenue item over the last 8 years, and that revenue item is how much we deposit into the stock market. And right now, I think that number is around 140,000 or 150,000 a year. So I will do that even if we lose money. I would do that because we're losing money has nothing to do with that revenue item. So I make a decision from day one that revenue item is going to the stock market. It's got a lot to do with my time. So a lot of consulting that I do would go into the stock market type of thing. So it's one of the things that I do, and has no bearings on the business. So you've got to look at how can you take money from the business to buy assets outside of it, but also if you need to, how do you grow the business? If you want to double your revenue, it takes working capital. And again, this is why we talk about the activities, because everyone will be at different stages. So understanding how much money it's going to take you to take your business from $1 million revenue to $2 million revenue, and how much physical cash it's going to cost you will be different. And that's why the activities are important. Then the question goes back to, how do you fund it? Like if you need an extra 200 grand worth of working capital, I see Martin's on here. There's different people out there that will help you get that working capital that you require to, grow your business. I was going to put him on the spot, but he didn't turn on his camera. But, so you've got the decision. Do I fund growth in my business through cash, or do I borrow the money? and most people here will know that we acquired another accounting firm technically a couple of weeks before Melbourne went into all those lockdowns back in February 2000. And there you go, Martin's up. In February 2022, we decided to acquire another accounting firm. And we used none of our money to acquire the business. So we didn't use our own money. We bought a business for $1 million. We used none of our own money. So there's providers out there, and Martin's one of those ones that can help in this case. And there's probably some other ones, but if you don't have cameras on, I can't see your beautiful faces. But there are strategies out there to buy a business or acquire another business that doesn't require you to put up front the cash. But it still means that you might need the working capital because your debt is now going to double, your wages are going to double, your overheads are going to double. There's still other requirements to that. So we have seen people that have, it's mostly new clients that we've seen come to us after acquiring a business and then realize that they don't have the working capital that they need to do that acquisition. So we've got to be really careful and understand the numbers, because the numbers will tell us a story of how much working capital we require. So again, this will be in my activities. There are definitely heaps of people out there. Martin's one of them that is able to help support from a cash flow perspective and find a lender that is suitable. But there are heaps of people out there that are in that space. Now, before I talked about the steel business, my idea here is that I've invested $500,000 into a steel business. It's under management. When I pay back my physical cash from that, I'm going to then put the profit into buying an investment property every single year. So I think about this and go from a financial literacy perspective is I invest $500,000. I pull that $500,000 back, it'll take me 1 or 2 years, probably 2 or 3 years. And then each year after that, I get to buy an investment property for what, 20 years. What a phenomenal investment that would be. So the differences that we have here is that I buy a business that could potentially buy me 20 properties over the next 20 years, or I could buy a car. I mean, the car would be fun, absolutely, until someone scratches it. Most likely my wife reverses it when she's parking into a pole or something, because that's happened a few times. Luckily to mostly her cars and not mine, but only once mine. And I look at this and I go, she's a great driver, by the way. I look at this and go, the financial literacy was telling me, screaming out at me going, don't buy that stupid car, even though it'd be really cool. Do this business instead. So I've got to make an educated decision around what is a better use of my money and capital. And I went down this path, which is why I've done it. And when I was doing that purchase, when I was doing that investment in the business, I was like, I'll put everything I possibly can onto a loan. So I'll just loan it all up and I won't use physical cash. And then I came to the problem of buying a forklift that I think it was around 20 grand, and the bank wanted 9% interest, and I have all my money sitting in an offset account. And I was like, 9% interest, that's probably not a good use. Probably not a good use of my cash with having the cash sitting in offset, saving me 5%. When I'm paying a 9% loan. So you've got to make a decision at that point of, do I buy that forklift in physical cash or do I use the finance? And each time I make that decision, I have to think about it. Do I need the physical cash to do something else? Can I do better than 9%? And if 9% is the average that the ASX gets when I invest in shares, then maybe I can't do better. If that's the average, maybe it's better off me putting it in saving the interest, not giving it to the bank and just buying the forklift. So that's the decision I made on the forklift. But on my truck, it was 5% interest. So I was like, well, I got the money in offset, that's saving me 5%. The truck interest is 5%. I prefer the money in cash sitting in my offset just in case I want to do something better with it later. So you got to make that decision between, do you use your actual cash or do you borrow money? And again, working at the return on investments of your physical cash will help determine that. And these activities will as well. So as I said before, I've put a lot of my money into properties, into the shares and into business. And I've wanted to do that to ensure that I'm financially free outside of my business. So every single day I make a decision to come to the office, I make a decision to come to work and to support people, not out of a financial need, but out of a want. And now I'm at that stage where, I'm really happy with what I do and I get to pick and choose who I want to work with. And I'm not driven by the necessity to pay my bills because I have this other income that can pay it. And that's financial freedom in its essence. It's that power to make those decisions, to invest the money, to spend the money without being constrained by I need to earn a certain amount of money. And I think that's really interesting that people always go, money's not important, family is. Sorry, someone private messaged me something quite funny, but money's not important, the family is. And I'm like, absolutely, family's more important than money. However, you show me a family that are really happy, that have no money, that are not paying the bills, they're about to get kicked out of their house, that don't have food on the table. You show me that family. Because money is important to get you up to the level where you've got the stability, the safety net, clothes on your back, food on the table, roof over your head. That's how important money is. And that's why I focus on it so much. Protecting your assets. So depending on everyone's position, and where you're currently at, different strategies would be in place to protecting your assets. So whether you have trusts, whether you have companies, self-managed super funds, all of them are going to vary depending on everyone's different needs. So what we'll be doing is sending out, again, another exercise that will show you the perfect structure. So some of you already have this structure, but there's a perfect structure to structure your business, to structure your wealth creation, but there's a cost to it. And that becomes a cost element of making those decisions. Not every single small business, not every single sole trader should be structured in a way that is very convoluted and complicated, which is why I wouldn't have done it with many of you, because it costs too much money to manage that structure. But it's good to know what the perfect structure is and how to use it and when to use it and why it's important. So I'll be sending that one out to show you all the different structures and why they're important and when to use it, and how you should be using it for your benefits. So what's next? So next week we're going to be doing part 2 of the financial literacy. I will be hosting that one as well. Normally we will be swapping and having a different guest speaker talk for the second webinar, but this topic I'm so passionate about, and I know you guys love to see my face and hear me talk. So I thought I would do this one as well. We'll be covering off on the perfect investment structure. So I'll run through some of those ones. I don't want to spend too much time on it because each and every individual person will be different. But I want to talk about how much you should spend on your lifestyle and thinking about that a little bit broadly, and how we can leverage off the banks to make more money. That's really what I want to be focusing on, those 2-3 areas. So we'll be covering off on that next week. And some people have asked me, why am I doing all of this? So over the years, yes, I will send the recording out to everyone that's registered. If you registered, then we'll be able to get the recording out to everyone. But over the years, I've seen a lot of people make a lot of interesting decisions. And I think those decisions would have been different if they have a different level of knowledge. And I feel like it's time that, me, Hatcher, I feel like it's time that we start educating people a little bit better. Instead of it being on a one-on-one when I do these meetings with everyone, I thought it's time that we start doing it the Hatcher way, and I start imparting some of these lessons that I've learned over the last 10 years with others and help other people achieve some of the things that we've been able to achieve. So this is why we're doing this. This is why we're doing the Hatcher Way program. It is designed to have expert guests come in and talk on different topics. Like next month, we'll have different people talk about the stock market, education on stock market education, properties, different types of properties. We're gonna have different experts speaking in those spaces. So it won't just be me. And some of the other ones, because I can't remember these all off my head, other topics we'll be going across over the next 10 months will be sales and marketing. So we'll have different experts talking about sales and marketing, strategic planning, all things tax, team hiring, culture, why you don't have money, scaling a business, systemizing a business, and healthy business, body, and mind. So they're the key pillars that I think are important for every successful business to be learning and understanding. We're going to have different people come on, talk about that in their own special ways. I'll put my own spin on it on the first webinar. Guest speakers will be on the second webinar, and we'll be giving different activities that are relevant for the topics in the third and fourth week, with some opportunities to do networking with different months. So that's all I have for you all today. I hope you've enjoyed my first proper webinar for 2023. Happy to stick around and chat to a few people if you would like. Happy for you to send through some messages. This will all be out on recording with maybe a couple little edits at the start. And thank you very much for listening, paying attention, and being great guests. And welcome to all those people that I have not met in person, because there are a few names that I do not recognize. Dane, you have your hand up. Is that a question for me? Put a spotlight on him. Why'd you put it down? No, you can ask away. I turned my phone on flight mode. You can't text me yet. Julia, great question. A great point about negative gearing and property. I'll probably do a lot about that. Next month, but I'm happy to go through it now. I think the premise for me of, say buying an apartment in CBD, having high depreciation, having relatively no capital gains over the next 10 years doesn't appeal to me. I might get some tax deduction, but I'm still going to lose 10 grand, 20 grand to get 3 grand, 4 grand back. I'm intrigued at that message there, Anthony. I guess are we spending Valentine's Day together? Is that what you're trying to allude to there?
Looks like it.
Is that Valentine's Day? That's awkward for the females that will be missing us on that day. That's probably why I have dinner booked the next day. That kind of makes more sense to me now. Look forward to seeing you on Valentine's Day. Someone actually messaged me earlier. They're not on the call now. They're going to watch this on record later. But someone did message me and ask me if I could go out to dinner with them. One of my good friends. And I'm like, I'm pretty certain my wife would think that's a bit sus. And I'm like, I don't feel like that's going to go down too well. So that's a no. But yeah, anyway, so I read that one. Wayne, thank you very much. I haven't, anyway, we can talk about that separately, actually. Does anyone else have anything that they would like to raise, chat about before we sign off?
Hey, Gary, I have a quick question. Thanks for that. That was amazing. Heaps of value, and I'll definitely rewatch it. If you were to purchase a property at the moment where the market's still sort of high, it hasn't really come back all the way, we'd been thinking about selling another property so that at least we're sort of buying and selling in the same market. But then after tonight, you've really got me thinking that it's not a good idea to sell property. You want to sort of hold on to it?
I think you've got to look at, I'll use my example here. So I have a townhouse in St. Kilda, Melbourne, and there's 5 or 6 of them, but I only own one. And the question that I have on that property, I used to live in that property, so it was a lifestyle choice. But the question I have on that property is, will the capital gains go up as much as it would the house next door? And the house next door, at some point, will get bulldozed and someone else will build 5 townhouses. So my belief is that that property, I'd be better off buying the house next door. It'd cost me a lot more money, but I'd be better off buying that house next door because the capital growth would go up substantially more than my townhouse will. And then we go back to the next factor of how much rent am I bringing in? And does that justify that type of investment? And in that case with the townhouse, it's got a rental yield around 3.5%. So for me, the premise of keeping a property, 3.5% rental yield, low prospects of capital growth, to me, it doesn't make sense. But if I exit out of that property, it's probably say 1.1, 1.2 million. If I exit out of that property and I was to buy a different type of property that had better rental yield, higher growth prospects, I'm all for that, which is why we are exiting that property, even in this market, because whether I exit it today, as long as I replace the asset within a reasonable amount of time, then I shouldn't miss any. If I sell today at the bottom and I buy at the bottom, fantastic. But if I hold on to the money for 3 years and then try to get back in the market, then I missed that uplift. Next week I'll go through. So next week I'm happy to quickly show you the technique that I use to determine if I want to buy a property or not. Or maybe I will just share that privately and we'll go through it next month anyway, in great detail.
That's awesome. Thanks, Gary.
No worries. Does anyone else have any other, except for Angela causing me problems with my wife, which I'm certain she's listening down the bottom. No, cool. Well, we might finish it up there. So as I said, thanks everybody for joining. I hope you learned a lot. This will get sent out on record and we look forward to seeing you all next week if you can make it.